Thanks for joining us today on Market Call. I'm Morella Fernandez. Darren Sissons with us on the show. He's partner and portfolio manager at Campbell, Lee & Ross Investment Management. He'll take your questions today on global and technology stocks. Here's how to reach us. 1-855-326-6266. You can also send an email to marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thanks for having me again.
When you look back at 2025 for the trading year, what do you think dominated? Was it tariffs or AI? I know it's a combination, but would you pick one over the other?
So, I think a recap would be, the year really has surprised to the upside. We had the tariffs, obviously, the big drawdown in April, and then we obviously had the markets move very strongly higher off the US. The budget, which is a 7% deficit plus an additional 13% for the defence budget. So that's very stimulative, and that caused obviously anything with growth, anything relating to AI to move. And there were a few sectors that obviously lagged. Obviously, healthcare was one, but the markets really were largely driven off the Mag 7, and really here in Canada. Gold companies surprised to the upside as well, which unsurprisingly, and I think a lot of people would have been caught off guard with that and perhaps underperformed as a result.
Okay, so where are we at the end of the year? How are you evolving your strategy from year end to the start of 2026?
Yeah, so I think looking forward, I think that the US is obviously going to be one of the big drivers for the year. We've got the midterms in November. I think that the president would obviously like his incumbent party to remain entrenched as deeply as they are. So I would expect a stimulative budget again. Defence is remaining to be an issue, obviously, with the conflicts we've got going around the world already. And obviously just over the weekend, we just saw that a Chinese plane locked onto the Japanese plane in a very aggressive maneuver. So I think moving forward, we would obviously see a similar outlook for what we've seen this year. I would be surprised if precious metals and gold moved again a much higher leg. I think at these levels, from a fundamental point of view, I think that sector looks fairly fully priced. I think the crypto guys might be a little bit perhaps disappointed as well. And I think that there's going to be a lot of opportunity for investors to perhaps look at opportunities for rotation. So if you look, for example, the guys that made money in gold, I'm talking everyone from the executives through to retail, could perhaps take some money and push it into the Mag 7, because the Mag 7 definitely underperformed. But also even below that tier, there are going to be opportunities. So we've made a few changes in the latter part of the year. We added obviously healthcare in the early part of the year, which worked out really well. And I think as we go, we'll continue to feel our way and look for high quality companies and that we want to hold for 3 to 5 years or longer if we can.
What about AI? Where does that turn to? Are you playing that in energy right now, or are you looking down the road at something else?
Yeah, so we obviously have the AI trade on. But I think in many ways, AI has the look and the smell of the .com 2000 era. And for those who were around then, what we had was a massive overbuild for optical networking equipment. And the market died when effectively the end customer had no more money to buy. And also the fact that the market was massively over-provisioned. So the question becomes, is a meme-generating solution going to transition into an application software company that can provide native executable structures in multiple languages and actually add real value? There's a lot of money being spent, but how much of that money is going to be redundant and just burn through? Like, I've yet to see a meaningful multi-billion-dollar opportunity in AI beyond semiconductor chips, which is just pure processing power addressing an end market. Like, where are the AI opportunities in the drug discovery market? We haven't seen them.
No.
Where are they in fraud prevention? What about the spam options? Like, how many times are people being spammed every day? Like, if someone could come up with an AI solution.
Protection options,
yeah.
Yes.
So, so if companies could come up with a solution to stop the fraud of seniors, and there's a big opportunity. At the moment, AI, in many cases, is just a chip processing story with a lot of hype on the end. Let's see some deliverables.
They can tell you what to buy and where to buy it. Okay, we're going to take a quick break. Darren Sissons of Campbell, Lee & Ross Investment Management taking your questions on global and technology stocks. Here's how to reach us. We're back in a moment. Welcome back. We're going to start right now with an email from Marie who says, I would like your opinion on Northland Power. We turn that over to Darren Sissons. Is Northland one that you know?
We know it. It's, to be fair, it's been a fair amount of a disaster, hasn't it? If you look at it, the stock's trended down, hasn't really done very well. Renewables in many ways is sort of, look at that drop, huge drop. And, but I think really if you look back, probably one of the biggest renewables in the space was a company called Ørsted, based out of the Nordic region. And if you look at it through the concept of PPP from an oil perspective, proven, probable, et cetera, what happened was when interest rates rose, a lot of the the projects became uneconomic. And so that was really the starting of the fall for a lot of the renewables companies. Northland has its own issues, but right here, we wouldn't be buying that. I think this is a company that has a significant issue. Algonquin had a similar chart and that didn't turn out too well. So, for now, I think in terms of the renewables, there are better opportunities to look. Once they bottom, there may be an opportunity, but from here, this is just not something we would touch.
Okay, good to know. Let's go to our first caller. Rob's on the line. He's in Calgary today. Hi, Rob.
Hi, good morning. Thanks for taking my call. I'd just like to get Darren's opinion on HSBC. I've held it for a while. It's had a nice little run recently. Do you have do you see any further upside, or do you think I should be looking at another player in the banking sector internationally? Thanks for taking my...
Thank you for the question. What do you think of HSBC?
Okay. So thanks for the call, Rob. So I think the question I think that we all need to ponder is, in an environment with tariffs in the Canadian economy where we're expecting interest rates cuts, why are the banks running as hard as they are? And the trend is global. So really, why is that trend going up when we expect interest rates to going down? Are the banks telling us that we're not going to see rate cuts? Are we going to see higher inflation? The long end of the curve is telling us we are. So, I think that's really the big question here. In Canada, if we're going to see interest rate cuts, a lot of the gains from the financials for this year are going to come down. In terms of HSBC stock, obviously a lot of that recovery is on the back of, they were the first company to cut the dividend during COVID. They got heavily penalised, and that was really the regulators forced them to do it. So you've got some upside here. I think it's a good quality bank, but it does have issues from time to time. We'd prefer JP Morgan, which I think was one of my past picks. Okay. But the question I think that you've got to get your head around is, are interest rates going to move higher? And if they are, then you want to be in the banks. If we are going to see them lower, then we're going to have a challenge.
All right, let's move on from Rob then to Amin, who's in India, who's in Ottawa, with a question about the Indian stock market, I believe. Hi, Amin.
Hi, good afternoon. My question, I need to buy 2 Indian stocks. What is his view and what are the best buy? 5-year.
Okay. All right.
Okay. So I think there's a couple of questions on the Indian market. Firstly, not everyone has the ability to buy it. Okay. So then, obviously we have a Canadian population that people have access to buy it. Perhaps some that don't. So for those that don't, I think the IT outsourcing companies look quite interesting. They've been heavily beaten up over their AI trade. So you've got everything from Infosys, which we previously owned. I think that's quite interesting. And I think the generic drug market is obviously something else as well.
Yes, they've done well there.
Yeah. And then, so what I would also, for those that can buy locally, and not everyone can, then I think Maruti Suzuki is actually a pretty good company. But you've got to be careful how you get execution on that trade. So it really depends on what your exposure is. So
what's the restrictions around investing in Indian stocks?
Well, you've got to have a license. Right? Okay. You've got to have a license here in Canada. So if you have the ability to buy that, but I would say that if you buy those companies, like the ones I mentioned initially, you can buy those in the US. And then if you can buy in the Indian market, Maruti Suzuki is actually a pretty good company. I like that.
All right. Okay. Let's move on to Peter in London with his question today. Hi, Peter.
Hi, Darren. I bought Lindy PLC about a month ago, and since then it's been dropping like a stone. Should I just cut my losses and get out of it, or is there any hope for this stock? Thank you.
Okay. Thank you for the question.
I think what we need to do is show the longer term chart on this one. Okay. We own this.
How many years?
I don't know, 5, maybe longer.
Okay.
I think, so the point that I would say is with this company, it's had a fabulous run. In fact, if you go back even longer, it's been very, very strong. So I think our clients are sitting on 2, 3x, and some perhaps even higher. Yeah. So look, in an environment where tariffs are potentially an issue, then you're going to have some pullback on the industrials, and all the quality industrials will pull back. But I would say if you're down 12% this year, buy more. I think this is a very good high quality stock. I don't mention it very often on BNN because it's just one of those names where it's just expensive and it just keeps going up. So we own it, we like it, and I would see a discount on this name here as an entry point. And I would also just reiterate that when this company spends and invests capital equipment, capital expenditures, what it does do is building new plant, and those plants are take or pay 20, 40-year contracts, 10-year contracts, and 5 to 10-year contracts. It's very, very strong in a context of a made in America reindustrialization. But it is a global operation. So,
and they do sort of gas and engineering, but is there a lot of growth for them in this field?
Yeah, for sure. So you've got regasification, you've got, so that would be LNG, you've got hospitals needing oxygen, you've got everything through the CO2 drinks, you've got cracking facilities or refineries, multiple applications.
Okay, so Lindy PLC, move in if you want to have a bigger stake in that. We're going to take a quick break. We're going to be back with Darren Sissons, Campbell Lee, and Ross Investment Management. Again, he's taking your questions on global and technology stocks. You're set to reach us. Back in a moment. Welcome back to Market Call. We have Darren Sissons with us today to answer your questions. We're going to start right now with an email from Sunny, who says, what does the guest think about Palo Alto Networks in New York? Palo Alto does security solutions, basically online. I'm also wondering if this kind of business is at threat from AI.
I'd probably say no. I think the one big knock on Palo Alto is clearly valuation. It's very expensive. But I think that if you think about network security, all the way down to security at the individual client level, it's a big growing market. Everyone is so attached to the market. You know, like corporately, every company's getting hacked every day. So the spin is not going away. I think one of the challenges you've got is it does have a variable bottom line. So obviously they're focusing on top line growth at the expense. I think the last 2 years they had a loss. So at the expense of operating profit or net profit. So that's a bit of a challenge. So if you're a little bit concerned or you're a value investor to some degree, it's probably not for you. And if you're looking for a dividend, then it's not for you. And obviously there's an issue around variability of the bottom line. A cheaper alternative, which may trigger or not for people that care about Israeli companies, is Checkpoint. So Checkpoint tends to be a little bit more slower growing, a lot more stability on the bottom line. But if geopolitical, whatever issues are for you, then that's not going to be it. But I think Palo Alto is a good company if you're looking for just pure growth. But if you are concerned about any variability, then maybe take a look at Checkpoint. I think Checkpoint's an interesting company as well.
Also American?
Checkpoint is listed in the US, but it's actually an Israeli-based company.
All right. Checkpoint Software at 189.03 today. Okay, thank you for that chart. Let's go to Elliot on the line in Hamilton with a question. Hi, Elliot.
Good afternoon. Like many individuals, I was kind of stunned by this $72 billion bid by Netflix for Warner Brothers, et cetera. My first thought was that they're running out of creative juice and they have to buy their growth. Please, what's your opinion on this Netflix situation? Thank you.
Okay, the situation being they're trying to buy Warner Brothers Discovery. There was a hostile bid announced today from Paramount Skydance. So their two might be in a bit of a standoff here. Is this a good move for Netflix, which has been trending down?
Yeah, so I think there's a couple of points. I think the first is that building content that can be repackaged, repurposed globally, I think is an issue. Like, obviously I have a Netflix account. I tend to watch a lot of the foreign movies. I think that's great. So I think the opportunity is there, but buying more content is interesting. Paying for Warner Brothers may not be appropriate here, but it's going to come with a hefty price tag. I don't know how much more growth there is in terms of subscribers that's going to come from Netflix. So obviously it's a question about how much more they can push the price point in terms of subscription revenue. If they have more content, better offerings, and that's the solution. The question around antitrust will obviously come to bear, considering there's another suitor at the table. I believe, the whisper is that other suitor is a little bit closer to the Trump presidency, so there may be some challenges. So we'll see. I think we're going to watch this with interest. If you own it, either one, perhaps be careful, risk manage it, and wait and see. But post an acquisition, when you've strapped on a lot of debt to fund an acquisition, you can have some hiccups thereafter. So be mindful of that as well.
All right, Elliot, I hope that works for you. Let's go to another caller. Mike is in Windsor, Ontario. Hi, Mike.
Would you be a buyer of NVIDIA at these prices with the upcoming competition with Google and China? Thank you.
Thank you for the question, Mike. NVIDIA, last I looked, was at about 183. There we go today, 183. A high of 207 earlier in the year, and it's struggled to get back above 200. Would you buy in at 183 today?
No.
Why?
And I think the main issue on NVIDIA is what it is Jensen Huang has done a fantastic job of convincing the world that an AI processing chip is an AI solution. As we talked earlier in the show, is it going to stop me getting spammed? Is it going to provide a development alternative in terms of new drugs coming to market? It will not. What it will do, it will provide a platform for software, big software data, to extract opportunities upon which to build upon. The market has completely missed the concept that AI will be all the value will be generated at the software level. So I think that's the first point. The second thing is, and this is the more obvious point, in 2022 the stock fell 70%. So look, if you want to do the trade, then just wait till it falls, and when it falls significantly, then you can buy it, and then and then you can taste the trade. But why take something that's down a little bit? It's like it's a half pregnant trade. So you either want it to be down aggressively, and then you can buy it, or you can just trend trade it, and just maybe you can be in and out of it. But if you're looking for a long-term hold, which is what we would not touch it at these levels. We would only look at it after a correction, and a meaningful one.
Okay, so where would you look at it about?
Well, 2022 was down 70%. So what, it's down, 10% from the chart, from what I can see? So just wait and see.
All right. Okay, let's move to another caller. Charlie's on the line in Montreal. He's got a question. Hi, Charlie.
Hi, thank you for taking my call. I'm calling about Novo Nordisk. I know you've spoken good about the stock in the past, being a great compounder, but now, like many people, I'm down 28%. But unfortunately, it's in my TFSA account, so I can't use it as a tax loss. What do you think? Is this still a hold, or do I just have to cut my losses? Thank you.
Can I get your take on the space for pharmaceuticals in general for a while? There's an overhang with the U.S. and what they're going to do. Right?
Can we see a longer-term chart on that? Yeah.
Donald Trump's trying to get prices lower for Americans.
So that in and of itself is a little misnomer. So we've owned this name we owned that name 9 years. We trimmed it 7 times. And last year, it was the biggest company in Europe. Okay, so we progressively took some money off the table. The stock really transitioned as generalists came out of the name, because Lilly got a slightly better obesity drug. Okay, and what will happen is, and CagriSema, which is one of the drugs, has not proven to be significantly better. So the only real catalyst in the stock were a couple of weeks ago they were going to have an Alzheimer readout, which did not prove the GLP-1 did not prove to cure that issue or address that issue. So the only real catalyst in the stock is they have the oral obesity tablet, which I think comes in Q1. So look, this is a very good company. It's in a market that's growing at double digits. The market is growing at double digits. Both of them will grow at double digits, but Lilly is currently slightly ahead. Now we're out of the stock now because we just saw that the catalyst for the stock to move forward from the current levels didn't make any more sense. So this is a complete risk off for us. So we're out of it, and we added another drug name earlier in the year. We're up 40% on it. So I think what you've got to do is you've got to look and see when the catalysts come, get into a drug stock, and when they're gone, you move on. But I wouldn't rule out us buying Novo if it gets significantly cheaper again.
And you said you held it for about 9 years?
Well, including this year, we had it for a portion of this year as well. And we trimmed it 7 times. So we were playing with the house's money substantially. It was a huge winner for us. But as you can see from the chart, we didn't want to round trip it, so it was just time to get out.
All right. Charlie, I hope that is good for you to make a decision. We'll take another quick break. When we come back, I'll look at Darren's past picks. That's next. Time now for a look at past picks from Darren Sissons, December 23rd, 2024, for just before Christmas of last year. At the time, JP Morgan Chase was the first choice, and we'll pull up the chart to tell you where it was at that point. Yeah. It was 238.39 US last December, now at 315.81, so 32% upside, 35% total return. Is JP Morgan something you remain invested in at this point? Did you trim it all?
No. So, a couple of things. So, firstly, the banking franchises obviously benefit from higher interest rates, stimulative government budget deficits, defense budget deficits, inflation, and so forth. So, all of that's played out. Then you've also got the Jamie Dimon factor where he gets free things or free companies from the Fed when we get a blow up, like Silicon Valley Bank back in the day. So, this is a great franchise. I think from when we've invested in it, we're probably not at a level where we would trim it. And if it was to trend a little bit lower here, maybe we might look to add a little bit more. But we like the franchise. It's obviously the structural differences of the US market versus the Canadian market, quite apparent. Like American banks don't own the mortgage asset, for example. But, very good company and, on weakness, definitely add some more.
Okay, that was JP Morgan. Let's move to your next pick, which was CSX on the NASDAQ. At the time, it was 32.32, and now they're up to 36.73 US, so 14% upside, 16% total return. And they do shipping, like barges, that kind of thing?
There's a rail company. So we're actually out of this name. We use the April lows, or maybe a little bit early in the year, to swap out of CSX, which I believe we'd owned just after the global financial crisis, so had really playing with the house's money, and we swapped into CP Rail because we wanted to get the pan exposure through from Canada, the US, and Mexico. So that logistics trade, be it rail, be it in some forms of shipping, the trucks, has not really been a great performing trade. But I think if you look at the longer term of the CN rails, the CP rails, over long periods of time since inception, they have been very successful trades from a total return perspective. So that's what we did. So we've swapped out of CSX, good company, but longer term, we think CP rail is going to be the better story.
And do you think it'll take time for that to turn around, considering the state of trade right now?
Well, I think, fundamentally, if you want to buy oranges here in Canada in the winter, you can get it maybe from California, get it made from Mexico, but it's got to be brought here. Right? If you want to have blueberries, and you can extrapolate and talk about lots of different things, everything from farmer all the way through to pieces for shipping, iPhones, etc. They've got to come some here. We don't tariff; the Americans are tariffing. So the rail network is pan North American. So I think at some point investors are going to realize that this is just a storm in a teacup.
Okay. Let's go to your third pick from last December, Mettler Toledo, MTD on the New York Stock Exchange. Weighing instruments.
Yeah. So this is one interesting one, and I'll just flag. So like all companies, it had a fairly significant drawdown in April, and from April lows is up 40%. So 13% year over year is quite good. So the global leader in scales, it's a US-based company, but with headquarters, R&D manufacturing facilities are out of Switzerland. So you've got the propeller head Swiss engineering expertise with American industrial distribution capabilities. Global leader in scale. So everything from the millionth of a gram weighing for drug discovery in terms of building new molecules, all the way through to the scales for weighing trucks on the motorway, and everything in between. Diversified market. They do tuck-in acquisitions. They don't pay a dividend, but they buy back 3.5% of stock every year. So whenever the stock is weak, they're buying back, and they buy it back throughout the year. And that's why when you look at the stock, it's actually a very expensive stock. It's about $1,400 a share at the moment. Yeah. It's been a very good performer over a long period of time, especially from a total return point of view.
All right. And I should have mentioned that it was 12 34 at the time you mentioned it, US last year, and up to 1,400 today, so 13% upside for Mettler Toledo. All right, we're going to take another quick break. We'll get back to your phone calls and your emails when we come back. Stay tuned. Welcome back to Market Call. Thanks for joining us. Let's go to David on the line in Oshawa. He's got a question today for Darren. Hi, David.
Hello, good afternoon to you. And I'd like to ask the gentleman about Shopify. I have a lot of it, and I'm holding it for quite some time. So I just want to know if it's to sell it or keep it, and if he does have it in his portfolio. I'll appreciate it very much. Thank you.
Thanks for the question. Shopify, pretty volatile, had a good Black Friday and following the weekend and did pretty well. Have you owned it at any point?
So we don't own it, really, because we have a valuation bias, right? We don't really want to pay for nosebleed valuation levels. But it has actually performed really well. I've had a number of meetings with the company, also at various conferences and things like that. I think the challenge you've got is really valuation, and it's a diaspora. It tends to cater towards sort of online fulfillment, as we all know. For me, really the biggest challenge is just valuation. And given we run a global book, we're looking for the best opportunities globally, and so it has performed very, very well in the Canadian market. But if you're looking for AI, you want to compare that to, so for example, an Oracle, NVIDIA, how's the relative performance? So a great Canadian story, but I'm just troubled by valuation. And that's for one of the reasons why we don't own it. But in terms of the guest question, look, if you've made some money, and I would say this for everybody, the gold guys this year, you never go bankrupt taking a profit. Take some money off the table. When you're playing with the house's money, if you do round trip that, it's fine. But you've actually diversified and put the money back into the portfolio. So never be shy of taking big wins off the table. And so if you've made some good money in Shopify, congratulations. Just be smart about how you manage your positions.
All right, let's go to our next caller, then. William's on the line in London, Ontario, with a question. Hi, William.
Good afternoon. I want your opinion. Should I buy more IBM, or do you have another database company to look at?
IBM? Yeah. So IBM's had quite the run, and I remember I used to personally play around with it when it was around the 140 range. It would drop down to 129, and then obviously what's happened now is it's sort of got the AI buzz. So if you sort of go back a little bit further on a chart, what you'll see, maybe a 10-year chart, what you'll see is it was sort of stuck in a band, and then all of a sudden it just rocketed. See 140 trade, you could do that. Whereas here, I think that. In many ways, this is the same trade that you've got with NVIDIA, but it will capture a solid portion of a software spend on AI ultimately. But the question has become, how far away from commercialization? So I like the company. I think it's interesting. It's portfolio sort of EV analysis where they buy and add positions to the portfolio over time to grow the business. So it's good business, but up around here, it's sort of the let's call it 310. I'm not really interested from a valuation point of view. The easy money's been made, and now what you're doing is taking effectively almost a term delivery from a birth perspective. Why would you do that? So we're not adding it here.
Oh, you wouldn't necessarily put more money in at this point?
If we owned it, I think clearly we missed it earlier. I was following it, but we didn't expect that kind of move. But at these levels, I think it's overvalued.
All right. Okay, let's go to Simon. He is on the line in Montreal with a question. Hi, Simon.
Hey, hi. How are you? I'd like to get your opinion on stock called Amgen, medical stock Amgen. Thank you very much.
Okay, thank you for the question. We'll pull up the chart for Amgen and have a look. Do you know it?
Yeah.
Tell me about it.
So Amgen was, Genentech was first, which is now owned by Roche, and Amgen was the number 2 biotech company, for lack of a better term. And so there's sort of two things that weighed on the name. Number one was their pipeline was aging, so that caused the stocks to come down. Obviously, the fund flows into big tech, mega, had to come out of somewhere, and it obviously came out of the pharmaceutical space. But what they have done, and I don't think the market's fully appreciated this, is many of the big pharma have gone off and bought pipeline. So they restacked pipeline about a year ago, maybe 18 months ago, and there's obviously the drug pipeline for new drugs coming on board is going to be quite positive. Robert Kennedy and his Making America Healthy Again, and obviously Most Favored Nations and the tariff also weighed on the sector. And that caused capital to move out. But I think, if you're looking longer term, I think the pharma, the biotech, the medtech looks actually quite attractive. Easy money was made earlier in the year, around the summer, when obviously the negative narratives was there. But at these levels, I quite like Amgen. I think it's an interesting story. Probably not my favorite name in the space, but I like the fact that they've rebuilt pipeline.
All right, let's go to a quick break, then we'll be back with Darren Sissons, Campbell Lee, and Ross Investment Management, taking your questions on global and technology stocks. More of your phone calls in just a moment. Welcome back, and thanks for joining us. Let's go to Trevor in Sierra Vista, Arizona, with a question. What's your question today for Darren?
Thank you. My question, Mr. Sissons, is on ASML, the Dutch manufacturer or lithography machine producer. And before even that, if you take a step back, I know you made a lot of money at private equity doing the cycles, the microchip cycles, and you made great calls. Are we at that stage now where it's at a low bottom where we can make money? If you could please explain. Thank you.
Okay.
ASML semiconductors?
Yeah, let's call it semiconductor equipment. So so Travis just made me feel old. Yes, I did start my career in venture capital, and then went into private equity, did fund investing, and then obviously more recently global equities at 3 different places. So that's my career. In any event, the old cyclicality that you saw in the semiconductor cycle has somewhat disappeared, and it's been masked because of the passive ETF flows just into the sector. So funds keep coming in, and so the cyclicality of the sector is much shallower than it used to be, unless you're a specialty player, a specialty investor, and you're looking at the sort of the mini cycle movements. So I think that's one thing. One of the big challenges is China tried to build its own semi-industry. The tariffs obviously came in, the sanctions, and that restricted China's ability to grow. They circumvented it in various ways. So I think the whole thesis around whether or not semi-cap should have more cyclicality now is very important. And obviously China and Japan saber rattling at the moment is obviously a big consideration. So that all being said, I think the outlook for ASML is quite interesting. The continued shrinkage, particularly at leading edge, it's the most advanced chips, requires the EUV solutions that ASMLs have. So I think you just look at it as an entry point. It tends to be a little bit volatile, a lot of recurring revenue, so a great company. And so we don't own it, but it would be a company, the kind of company that we would add if we got an opportunity.
All right, let's move on to an email then from Ian, who says, what do you think of Meta as a long-term hold? The stock has recovered some ground from its recent sell-off. Would you still be adding at this level? As you know, the concerns about Meta are spending and how much they are spending on CapEx, although they're pulling back on Metaverse. There are reports that they're going to cut that budget. Would you hold Meta? Do you hold Meta for a longer period of time? We
don't own it. And I think, I mentioned previously NVIDIA was down 70%. So in 2022. So in 2022, if I remember correctly, Meta was down 72%. So look, if you like the advertising data analytics model and how that all evolves, and I think that business has upside. Like, why do you want to buy it before it corrects? Because companies periodically have correction, and you typically get a correction. So look, if Donald Trump loses the midterms next year, and he does not have the ability to produce stimulative spend in his third-year term, big tech could come down very hard. So just wait for an opportunity. So if you see that on the chart very clearly, you can see 2020, 2023, the dip. The money that's been made since then has been very accretive. Your portfolio would have grown significantly. So don't chase risk when it's just corrected a little bit. Chase it when has had a fundamental correction, and that's where you make the big money.
I think a lot of investors are looking at the downside here and thinking, okay, this is as far as it might go, and so they're going to pick it up, or they want to know whether they should pick it up. But you're saying you anticipate there'll be some more downside.
There's always downside. Like we talked about Linde. We saw the chart. It's a fantastic name, but it has a correction. Every company will have a correction at some point. Sectors have a correction. So, be smart about it. But I think the broader point is, don't just have one name you're following. Have 4 or 5 names that you follow closely, and you're looking to see, not in the same sectors, and look and saying, okay, if I have an opportunity, let's push some money into this name. Don't just say, I've got 2 companies focused on the AI space, and if they continue to do well on a small correction, I'm going to add some money. Okay, you can do that, but that's a trade, and it's a modest upside. Where you make all the big money is you make money when you buy, not when you sell. So when you buy correctly at lower prices, and then you get the run up, that's when you really make the big money. So focus on those trades, not on the picking pennies up from the motorway trades, because they're the ones that hurt the most.
All right, let's get in another caller here. Faisal's on the line. He's calling from Toronto. Hi, Faisal.
Hi, Mirella. Good afternoon to you both. Thank you for taking my call. Darryl, it's good to see that we have a balanced voice. You're not one of those euphoric bulls, and valuation does matter. That being said, I'm calling on First Service. It has sold off. It's a good company. Is there something there that the market is telling us, or it's just sentiment is not there? If I can get your thoughts, please, I'll hang up and listen. Thank you.
Can you tell me about First Service?
So good point. So First Service was started by an individual who ran a painting company, student painting, and he built it into that enterprise. And it has a number of different sub businesses. Now, I would say this is probably one of the ones from our Canadian allocation that we've missed. It's been a very, very solid performer over a long period of time, particularly if you go back further. It does tend to bounce around a little bit, but at the moment, like if this was to go down significantly, then we'd probably be scheduling a call with management and maybe having a discussion, because the longer term trend of this company has been very solid. And it's a collection of businesses. Maybe think like a Constellation Software, where you're going buying businesses and you're putting them together, and it's just been very well run and very well managed. But right here, I think it's a little too early to say. But if this was to go down much further, it'd be something that would definitely worth, from our point of view, paying attention to and taking a closer look.
All right. I think that does it for phone calls and emails today, so we've got to leave it there. We're going to take a quick break. We'll have a look at Darren's new top picks when we come back. Join us tomorrow on Market Call. Hap Sneddon will be on the show, President and Chief Portfolio Manager at Castle Moore. He'll take your questions on technical analysis. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Darren Sissons. We begin with Brookfield Corp, BN on the TSX. Very well-known name. What do you like about this branch of Brookfield as opposed to the other Brookfields? Yeah, so let's just sort of talk about a couple of things that perhaps haven't been covered on the show. So I think the first thing is, and I'm ex-private equity, a fund investor into the likes of a Brookfield. In the old days, the company was funded through institutional investors giving the money, and after 12 years, you had to give it back. So what has happened now, by tapping the public equity markets, they're now able to own assets for longer-lived assets for a much longer period of time, and they don't have to give it back. So that's actually enabled them to expand their operating footprint and obviously to grow the franchises, in addition to the capital they get from institutional. So I think that's good. And I think the other thing that the market's not really talking about is, given the high levels of debt that developed economies have really across the globe, we're going to see at some point a Margaret Thatcher era privatization strategy, where what we're going to start seeing is sovereign assets are going to be sold off. Companies like Brookfield will be well positioned to participate. Like, for example, Pearson. You go to Pearson, it's a bit of a disaster when you come through. Private equity sorting that out would be great. I think everyone who's gone through that airport would appreciate that. So these types of assets across the globe will be available at some point, and companies like Brookfield will participate. So I think that will be a catalyst,
moving forward over time.
Okay, let's get to your next pick then. Intercontinental Exchange, ICE, essentially on the New York Stock Exchange. What do you like about this? And tell me a little bit more about how the business works.
So what the business works is obviously they run stock markets.
Yes.
Yeah. So what do stock markets benefit from? Quantitative easing, government printing, inflation. When you have periods of distress, like for example, we've seen the big sell-off, the market, people are trading their book, and obviously passive investing flows. So every person who has $1, allocated from their paycheck every month going through, has to pass into passive ETFs, and that's being spent. So all of those types of supportive dynamics that cause the company, cause the stock markets to grow, that will be harvested through that company. They're acquisitive investors on a tuck-in basis. They recently bought Polymark. I think if you look at it longer term, the exchange business does not need a lot of capital to run. So it's an asset-light business model with a global scope of operations. And I think for the longer term, owning exchanges is quite a good way to harvest the growing stock market value.
All right. I do want to get to your next top pick, Straumann Holding AG. So this is a dentistry sort of company. They do restorative kind of dentistry. Are they the company that holds the dentist's office, or what do they do?
So they make the equipment. So for example, if you are playing sport, playing ice hockey, you lose a front tooth, you go get a crown. So they are the global leader in restorative dentistry, things like crowns, all the way through. They have obviously the premium Straumann brand, and they have a couple of other brands that they tend to operate in. The market grows in Canadian dollars organically about 9.5% per annum. So good organic growth. They do tuck-in acquisitions, very good balance sheet. They have digital offerings. The stock sold off really on the back of the tariffs, and also on the back of the exit of the super cycle for broader healthcare. The tariffs are really largely irrelevant because they have production facilities in Ann Arbor, Michigan, so they can support the U.S. market. They may do a little bit of restructuring of labor codes, but ultimately what will happen is it will just be a continuation of what they've done for the last 10 years, and they will just continue to move forward. It's attractively priced here. So we've watched this name for quite a long time and finally got the opportunity. So
is it a competitive space?
It is the gorilla in the space. Yes, it is a competitive space, but the competitors are of an order of magnitude smaller. So what you will expect them to do is at some point just to buy other competitors regionally, product-wise, technology. So they would be the NVIDIA in the AI semiconductor space.
Okay, and they manufacture, you said as well, in Michigan, which means they can avoid tariffs.
Correct.
And that's a big factory there, something like that?
They have a factory sufficient to support the US market. But not just in the US, they have that can supply the Canadian market. They have other production facilities in different markets. So the US, the stock is sold off because of the US tariff exposure. But that's not the only drive here. They're also in China. China's growing quite quickly. Korea which is a very fashion conscious market. It's not a big market, but it's actually a market that they do quite well in. They're in Japan. So if you think there's money to be made in teeth.
If you think there's money to be made in teeth. Okay, I just want you to revisit for a moment your strategy as we move towards the end of the year and start of the new year as investors think about sort of what changes they want to make to pivot to 2026.
Yeah, so I'm a little bit unsure, perhaps from a rate point of view, whether or not we're going to see higher rates, particularly like here in Canada, for example. If we've got the renegotiation of the America-US trade agreement,
which may or may not happen.
Which may or may not happen. You've also got some challenges that have fallen out from obviously from trade. The economy's quite weak. Why will we not see lower interest rates? That's not good for the financials. Having said that, if inflation comes through at a higher level, then higher interest rates will be a concern that we have to consider. Obviously, the employment data came out this week, I think today, and then obviously the backup in the longer term rates is a concern. Looking sort of into the equity markets, I would expect more of the same from the US. I think that the defence spend in Europe is going to be a catalyst, so that may be something we look at. And I think, and I'm talking more broadly, I think we've probably got enough healthcare. I think we've probably added enough healthcare there. So we may look at rationalising a couple of names. We may even de-emphasise Canada a little bit, looking forward. And I would expect some recovery in the logistics names. And then the consumer segment might be interesting, particularly more the luxury. I think that might be an interesting space to look at.
Interesting. All right. So logistics, which have been badly beaten down as well this year. All right. We've got to leave it there. Darren, thanks for coming in. Good to see you.
Okay. And happy holidays to everybody.
Thank you very much. And thanks for joining us today on Market Call. We'll see you back here again tomorrow.